Sorry for that abrupt end on part 1. I forgot that my video recording has a 15-minute limit. So now this is part 2 of the impending market crash, of the stock market crash. Now, in summary of part 1, now is not the time to invest in equities in the stock market. Why? Because we're way too overbought. The MACD of the S&P 500 is had been way outside the upper mids for quite a long time, and I'm already telling you that we reached the peak because the prime and the prime in of the S&P 500 is now residing below the zero line. This is the zero line. It's now here below the zero line. And the other sanity check to know that an impending market crash is going to be happening is when you look at the short-term government bonds. The short-term government bonds will peak above the zero line, and it will stay above the zero line as the stock market is going towards the zero and below the zero, and the primes of the stock market will go below the lower mids. Now, if you didn't believe that, go back to the housing crisis, which happened here in late 2007, early 2008. You notice that the primes of the S&P 500 went below the danger zone and went below the lower mids. As that was happening, look at the cursor on the bonds, short-term government bonds. On the short-term government bonds, we notice that as the stock market was losing money in January of 2008, the government bonds MACD has crossed above the zero, actually peaked outside the upper danger zone, and the primes are outside the upper mids, telling us that, oh goodness, I should pull out of the equities market and move everything into bonds. So this is currently the picture right here on the bonds as of February. This is the picture of equities, the S&P 500 as of February. Once again, the primes have been staying below the zero line. Here on the bonds, the primes have been staying above the zero line. It just needs to turn up together with the pin to carry the MACDs across the zero. Then the market crash would have begun as the primes and the pin of the S&P 500 goes below the lower danger zone, headed towards the lower mids. So this pretty much gives me the answer to the question I asked the Holy Spirit. Should I have this insurance company manage my retirement portfolio where 60% of it is going to go into equities? The answer is not at this time. The time for me to allow this possibly allow the company to put my monies in equities, or for me myself to manage it myself and put my retirement funds into equities, is once the MACDs of the S&P 500 has finally valleyed out and the fast MACD crosses the slow MACD and the pins and the primes are outside the upper mids. That's the time for me to go into equities. So thank you for staying with me as I explored the answer to why should I go into equities now at this time, and the answer is no. So that ends part 2 of Now for Something Completely Different. I love the gift of these Sangha trading oscillators because they can be applied anywhere you have time versus price data. Many blessings. Take care.